My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'm to my friends, just trying to make you a little money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Maybe everything's still too high. And that's what Fed Chief Jay Powell's fighting in his war against inflation. Every time I think prices for everything have started to go lower, including stock prices like we saw last week when they plummeted, we get a nice bounce. Dow gaining 641 points, S&P jumping 2.45%, NASDAQ pole vaulting 2.5%. Yep, it strikes me that the Fed's still got a ton of work to do if we're going to get inflation under control. And make no mistake, that's the only way that this bear market truly comes to an end. Now, according to the great market historian Larry Williams, the average bear market lasts roughly 180 days. We're at day 190. That's how long it's been since the Fed declared war on inflation last November, although it didn't really get serious until this year. It makes you want to believe today's the major trend, not a minor court. But until the Fed makes more progress, I don't believe the decline is over. And you need to lighten up on days like today, as we did with my charitable trust, as investing club members know all too well. What needs to go down more? Well, let's start with oil. Our government's approach to pushing down the price of crude is totally unserious. President Biden would rather go hat in hand to Saudi Arabia than make nice with domestic producers here in America. The White House has a schizophrenic attitude toward oil. They don't want new pipelines on environmental grounds, but they also want to get energy inflation under control because high gasoline prices are lethal to getting reelected. Even without doing anything else, Biden could at least suspend the Jones Act so that foreign ships can bring oil from Louisiana and Texas to New England, where it's really needed. Right now, those tankers need to be American, and most of the fleet is foreign. Instead, we hear about a tax holiday for gasoline, 18 cents. Kind of like the Strategic Petroleum Reserve, tiny temporary attempts to deal with a much bigger problem. Sometimes I wish they would just call me in so I could tell them the oil industry is not the enemy. They want a lot of what Biden wants, but they don't know how to ask, and he doesn't know how to tell. I'm inviting David Faber on tonight to talk about his documentary on ExxonMobil and see if there's any way to get the most visible sign of inflation down. Can Biden ever sit down with Americans who happen to be involved with fossil fuels, or can he only sit down with Saudis? Another reason why inflation is so ingrained, take the breathtaking news from home-building giant Lennar this morning. It had amazing earnings, but then proceeded to tell you how the future won't be as great as the past. So far, so good for Jay. Lennar highlights one of the strongest housing markets in the country for the last few years in Seattle. Listen to this. While market fundamentals with limited land supply and low inventory remain extremely strong, buyers have pushed back for a reset in pricing. So far, so good for Jay, right? Meaning despite land shortages, buyers are saying no. They go on. The higher-priced and highly sought locations around Seattle have seen a significant pullback in sales in May and early June. Wow, that's terrific from an inflation perspective. They continue. This pullback is a result of both continued price appreciation in the first quarter, causing concern over home values being overpriced, and stock market corrections, which had a direct impact on employee stock compensation plans, and not to mention higher interest rates. Yep. In short, higher interest rates, lower stock market, they are doing their job, causing consumers to pull in their horns. It's all good for the Fed so far, except one problem. After all that negativity and caution, we learn this, quote, once again in this market, we are at prices that are still significantly higher than the year-ago period, higher. So after the higher rates, declining stock prices, lower price adjustments, we still haven't popped the bubble. Scarce rentals and greater household formation inexorably drive home prices higher. So, in other words, all of this stuff that I read that made me feel like, you know what? We are going to be seeing a top in interest rates sometime soon. Wrong. Just wrong. There is good news in this report, though. There are a lot of rich towns where Lennar is building. When I was out west in Silicon Valley, I heard many execs how they intended to pull up stakes from their home turf and move to some of these towns, the ones that were mentioned, Atlanta, Charleston, Nashville, Reno, cities like in Colorado. This pattern is consistent with what Lennar is saying. Why are these tech companies moving? Well, there simply aren't enough engineers in Silicon Valley, so wage inflation is nuts. And because there are so many potential employers, these engineers have all the leverage. So the companies would rather move to new cities where there are fewer potential employers and people can't job hop as easily. Job hop, remember that term, that's wage inflation. Oddly, these new wealthy cities are a godsend for Jay Powell because he needs to break still one more cycle, wage inflation. And the tech industry is finally doing something about it. It's walking. I predict the first mass layoffs will be in, of all places, Silicon Valley, as the larger companies migrate to cheaper locations and the smaller companies struggle to raise money. Beyond housing, Jay Powell needs stocks lower in order to beat inflation, but things aren't totally static. I mean, take Kellogg today, right? Kellogg got, like many companies you're going to see, Kellogg got fed up with their low stock price. Didn't seem like they could do anything. So they decided to break up into three companies: a global snacking and international breakfast play, a North American and Caribbean cereal play, and a plant-based foods play. Now, I'm all in for this, as there's strong demand for each of these products. We know remote work generates a ton of snack demand, including a love for Pringles and Cheez-Its, which I actually insist is real food, not just colored facsimiles. My kids vehemently disagree with that. The market liked the Kellogg breakup. The stock valued almost 2%. But the more I dug into it, the more I realized that people like it mainly because the company's been able to put through big price increases. Once again, the food shortage has forced processed food companies to pass on their cost increases to the consumer. And that is very bad news for the Fed's war on inflation. Like homes, you need food prices to be rolled back. Kellogg's acting like that's not going to happen. Hey, they know. They're the food company. By the way, I do like the Kellogg breakup, as the remaining company will keep its solid dividend when you put them all together. And I think the plant-based spinoff could end up getting acquired by any packaged food player that wants to diversify away from the processed stuff. But mostly I like it because it can put through all the price increases at once, because Kellogg's got such a good brand name. From the Fed's perspective, I argue that the stock market is the most intractable beast of all. I don't like it, but if Powell wants to beat inflation, he needs stocks to keep going lower, not higher like today, because the wealth effect is so potent. In recent years, bountiful gains in the stock market have allowed the winners to spend like crazy. If Powell can get this market to go down and stay down, repealing much of those gains, then the rich are less likely to spend aggressively, and a lot of people are more likely to remain in the workforce when they might otherwise have retired. But this market, it just refuses to roll down and play dead. A total affront to what Jay Powell wants. You know me, I'm always in favor of higher stock prices because you have a portfolio and I want you to make money. However, I've lived through enough tightening cycles, and I know that this has to happen before Powell can declare victory. That's why right now the best outcome would be for the averages to come down quickly so we can just get it over with. Powell's probably hoping today's action is just another temporary bull spike in a broader bear market. The bottom line, Powell had better hope this run won't last, or else those beach house prices, new construction jobs, Lennar homes, processed food stocks, and oil prices won't be going down and staying down anytime soon. Let's go to Stacy in North Carolina. Stacy.
Oh, yeah, Jim from North Kakalaki.
How are you?
Thanks for taking my call. Good. Long-time listener, first-time caller. The stock
Excellent.
I'm asking about today has been wavering between 170 and 175 for a few weeks. Its 52-week high is at 233 and has a yield of near 3.5. The ticker is UPS. Is it a good time to buy or let it ride?
The stock has come down a great deal. It got that contract, the extension that I was so worried about. So the answer is, Stacy, yes. 3.48 yield, Carol Tomei, contract, 13 times earnings. Call me a buyer. All right. Powell better hope this run won't last, or else those beach houses prices, new construction jobs, Lennar homes, and yes, processed food stocks and oil won't be going down and staying down anytime soon. He needs that. Let's get it over with. On Mad Tonight, you called in and asked me about Goodyear, and I invited the CEO to join us on the show to break down the latest because the stock has plummeted. So I'm sitting down with the company's top brass to make sense of the recent action in the stock. Then, two analysts, two price target cuts. I'm taking a bite of sweet green to make sense of how Wall Street is viewing unprofitable growth stories in this environment that you happen to like to go to. Plus, the oil patch has become one of the hottest sectors in the economy. So that lets me sit down with my squawk on the street colleague, David Faber, to discuss what he's learned in his upcoming documentary on Exxon. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.